Have you ever perfectly mapped out an order block, patiently waited for the price to return, entered your trade, only to get immediately stopped out by a fake breakout? Oh, it's literally one of the most frustrating experiences in trading. But here's the truth. Not all pullbacks are created equal. In this analysis, we're going to explore the core mechanics of market structure to figure out exactly why that happens. We're going to look at the market through the lens of a trap versus treasury narrative. By the end of this explainer, you're going to know exactly how to distinguish a highly dangerous market trap from a high probability trading treasure. Okay, let's dive into this. Today's roadmap is pretty straightforward. We're going to cover the nature of pullbacks, aggressive versus corrective momentum, the liquidity sweep model, safe entry strategies, and finally, some absolutely crucial testing principles. Section 1. The nature of pullbacks. Understanding market mechanics. To avoid market traps, we really need to strip away all that chart noise and understand true market mechanics. Basically, a valid pullback is a temporary reversal where a candlestick breaks below the lowest point or above the highest point of the previous candle. It sweeps its liquidity. If you don't identify a valid pullback, you simply can't recognize upcoming price movements, continuation trends, or authentic order blocks. You've got to have this rule memorized. If the price fails to break the low of the preceding bullish candle during an uptrend, well, it's not a pullback. It's just a single impulse move. Following this rule is completely mandatory to avoid invalid setups. Now, here's a surprising fact that trips up so many beginners. Candle colors simply does not matter. Traders constantly get distracted by these sudden flashes of red or green impulses on their screens, assuming a pullback is happening just because the color changed. But true market structure, it's blind to color. It only cares about the highs and the lows. You could literally have 3 bearish candles in a row, but if none of them break the lowest point of the preceding bullish candle, you do not have a valid pullback. Moving on to Section 2. Aggressive and corrective pullbacks, also known as spotting the trap. Now, what's really interesting here is what happens when the price actually returns to a demand or supply zone. Let's look at the aggressive pullback first. This involves rapid, sharp, massive candles with high momentum barreling straight toward your demand zone. Let me be clear, this is a highly dangerous trap. If the price rapidly drops into your zone without subsiding its momentum, there is a massive probability it's just going to blow right through it. Do not enter there. Conversely, consider the corrective pullback. This is your treasure. It's a gradual retracement forming multiple smaller internal structures. The momentum is subsiding as it approaches your point of interest. This tells you the market is actually taking a breather, making it a much safer zone to start looking for entries. Alright, Section 3, the liquidity sweep model. This is the highest probability setup you can encounter. To really understand the sweep, we have to talk about static liquidity zones. We're talking equal highs, equal lows, or trendline liquidity. Think about a double bottom forming. To a lot of people, that looks like a super strong floor. But to the market, it's a massive cluster of pending orders and retail stop losses just waiting to be triggered. The market actually requires this liquidity to gain momentum. So the crucial point is this. If the price does not sweep liquidity before it hits your key level, it is going to use your zone as the liquidity. Yep, it will hunt down your stop loss to fuel its momentum. However, if you do spot a liquidity sweep pattern, like say the price dipping just below equal lows to grab those stop losses right before touching your demand area, that is the ultimate confirmation of your zone's strength. At that point, you're no longer the trap. You're trading right alongside the momentum. Next up, Section 4, Entry Strategies. Let's talk about executing the safe trade. Let's walk through this mechanical sequence step by step. Let's say you've got a beautiful corrective pullback or a confirmed liquidity sweep. Step 1, You patiently wait for the price to actually top your higher timeframe supply or demand zone. Step 2. You zoom right into a lower timeframe to monitor the price action. Step 3. You're looking for a change of character, or chach, a clear market structure shift signaling a reversal. Step 4. Once that new lower timeframe zone is created by the chach, you set your limit order right there. This conservative approach is a real game changer because it gives you a much better risk-to-reward ratio and allows for a significantly tighter stop loss. Finally, Section 5. Testing Principles. This is the disciplined trader's rule. 100. That is the absolute minimum number of times you must backtest these specific strategies. Seriously, no shortcuts here. You need to open historical charts, locate your zones, identify those valid pullbacks, and track the change of character outcomes. Systematic consistency doesn't just come from guessing. It comes from logging the data and proving the model actually works for you across at least 100 setups. So, I want to leave you with this final thought to ponder as you open your charts today. The next time the price reverses and heads straight towards your carefully drawn zone, are you seeing an opportunity or are you staring at a trap? Look for those structural highs and lows, watch the momentum, and always wait for the market to show its hand. Keep learning, keep backtesting, and we will see you in the next explainer. You absolutely need 3 things here: a clear trend, a retreat to base, and a defensive reversal signal. Mechanically, it's simple. Sellers attack, buyers defend, and we jump in with a safe stop loss right below. Now, scenario 1. The basis is just fresh territory that buyers literally just snatched from the sellers. Or scenario 2. The price drops way deeper, going all the way back to the wave's original bottom. Watch out for scenario 3 though. If it drops before breaking the previous peak, that's market weakness. Avoid it. Mechanically speaking, that deeper drop offers a way stronger base and a much safer stop loss. This perfectly lines up with Dow theory. That origin bottom, it always acts as your crucial defense line. But here's the catch. Catching a shallow pullback can actually be better if the overall trend is super aggressive. You gotta look at the big picture. Combine trend strength, base solidity, and candlestick signals to make it work. And hey, a quick reality check. Literally, no trading strategy wins 100% of the time, period. Long-term profit isn't about being perfect. It's about consistently sticking to your logical game plan day in, day out. So, armed with these mechanics, are you ready to build and execute your very own pullback trading plan?
In this video, the visuals are used as illustrations to help you better understand the content. If you would like to explore the topic more deeply, feel free to join our community where you can learn new knowledge and exchange ideas with others who share the same passion.